Morning, guys. It is Thursday, right around just afternoon when I'm recording this, so it'll probably be about 12:30 by the time I finish recording and it gets uploaded. I know I've told you guys quite a bit about watching the 10-year, and if anybody is paying attention to this, which you guys know I do, 10-year bumped up over 1.75 today, which is where you start to get scared, okay? And as I'm sitting here right now looking at live, it is 1.3 or 1.735. So you are right on the cusp, all right? Now, I'm not going to try to get all wonky with you here and everything. I know a lot of the stuff that swims around in this fish tank here is a lot more in detail just because of my background than most people know. And I'm not trying to insult anybody's intelligence. It's just this is what I trained for, okay? But I kind of want to explain why this is so important, okay? Because what you're seeing right now is probably the top or damn near the top of the stock market before everything falls apart, okay? And I'm not saying it's going to happen tomorrow, okay? But we're there, all right? And I just kind of want to explain to you guys how this kind of works, see if this makes sense and everybody can understand what I'm talking about, all right? So if you go to 2019, for example, the government spent about $4 trillion, all right? And took in about $3 trillion in tax revenue. So this is where you get deficit spending. So we had a $1 trillion deficit spending. Okay. Obviously, if we spent more than we took in, just like your house, you're borrowing money. All right. Now, the advantage to them being able to do this at that point was that interest rates that they were borrowing that $1 trillion on was low. All right. So we wound up paying somewhere around $400 billion in interest on the spending. So about 10% of our total spending went to pay interest. Okay, so please understand that part. We spent $4 trillion, we paid $400 billion in interest. That's debt service. Okay, that's the term you hear there. Now, you kind of look at where we are now. Interest rates have nearly doubled in the last they've nearly tripled, in the last 6 months. So you start looking at this as the interest rate goes up, the cost to borrow money continues to go up. We have more debt service that we have to pay. This is why the Fed is artificially trying to keep rates down, because they're constantly borrowing money, okay? It's not like we did all this 10 years ago and now we're just paying it. I mean, you get new bond issues that are coming out constantly, and they have to come out at what the prevailing that day's interest rate is. So now the money that we're borrowing today, for a 10-year loan, okay, the government is paying if they put out notes today, it would be 1.75% interest. This is where it gets scary, because I've told you guys what interest rates looked like back in the 1980s, et cetera, et cetera, et cetera. Okay. And this comes off an article that I had just read. Okay. And I'm just going to read this paragraph to you. So I want you to think about this. Like I just said, about 10% to debt service back in 2019. At $30 trillion in total debt and counting, if rates were allowed to rise much higher to anywhere near the historically normal range of 5%, that would mean $1.5 trillion in annual interest expense for Uncle Sam, which would equate to 50% of national revenues. Okay, now again, like I said, 1.5 trillion, and if Uncle Sam only takes in $3 trillion, that means half the tax money it takes in every year would have to go to pay off the debt, or to pay the interest on the debt. I'm sorry, not pay off the debt. Okay. That's not sustainable. Think of your household. And I know there's been, for years, people have gone, if the government managed the budget like you manage your household budget, you'd be broke. Okay. But think about that. If 50% of your household income, let's say you make $50,000, okay? If $25,000 of that 50 grand went to pay the interest on your house note, your car note, your credit card, not the principal, just the interest, you're done, okay? You're bankrupt. You can't pay that. It's just not possible. It doesn't matter how big the numbers get, into the millions, the billions, the trillions, whatever it is. Eventually there comes a place where you can't pay the bills, okay? And that's what I'm saying with this 1.75. This is the threshold, because now what you got, okay, and this is where I say a stock market crash is coming. It's now more lucrative for a investor, if you will, who's lived, I mean, think about the majority of people that watch this channel live on fixed income of some sort. I mean, whether it's Social Security, whether it's interest from your investments, whatever it would be, okay? If you buy a 10-year bond right now, it's going to pay you 1.75%. If you're buying the S&P 500, the dividends on the S&P 500 right now are about 1.46%. So if you're living on the income, you're better off having bonds than you are having stocks. I'm not telling you to go buy bonds. I'm not giving anybody financial advice here. I'm just trying to educate you guys a little bit here, okay? If everybody, I know I get the emails, the comments all the time. People say, what should I do? Guys, I can't give you that information. I don't know your situation, okay? You need to talk to your broker, your banker, your whoever who knows, I mean, your age, your health, your what your net asset value or what your net worth is, you know, the whole 9 yards. There's way too more to this thing. It's buy here, sell there. It's not that easy, okay? But this is what I'm saying. We're now to the point where it's getting where the government cannot afford to borrow money because they can't afford to pay the interest. The hell with paying the principal. They're not going to do that. We've known that for decades. They're not going to pay the principal. So this is the problem, because now you have the Fed coming out and saying, oh, gee, we're not going to do anything until inflation, you know, raise rates or do whatever until inflation rears its ugly head. Well, I mean, again, they're still working on this fake inflation of between 2 and 2.4%. And I talked to you guys about that the other day, what historically it is, okay? Historically, for the last 37 years, it's been 2.5. So they're figuring we're going to be in a low inflation year. Okay, I want to know what kind of drugs they're smoking. That's just not realistic. But so what you wind up having happen here is we could wind up in a negative interest rate scenario where the only way that they can do this is to reduce the rates, which is just accelerating bankruptcy. Okay, that's all it's going to do. This goes back into what we've all said over and over and over, okay, is where you probably want to be at this point is in precious metals of some sort, okay? Again, I'm not giving anybody financial advice. You got to do what you feel right, and God knows I don't have a crystal ball. So, I mean, I can't tell you with any certainty. I'm just looking at, again, historically what happens, all right? And looking at rates getting up here and the government not being able to, getting close to not being able to service the debt. As soon as that happens, that's when the economy completely falls apart. The one thing that will fall apart is the stock market. Okay. There's a lot more to this. I could get into a total, like I said, wonky deal about how this all works. The only thing I'm just trying to explain to everybody is, guys, this is we're now in the danger zone with the 10-year treasury rate and the stock market. Be very, very, very careful with your money, because you know you're already seeing the market slightly down today. This is just happening. We're kind of sitting on the fence. It's a teeter-totter here, okay? And which way is it going to go? And eventually it's going to go one or the other ways, okay? This is this real tight balancing act. Like I said, you know, 2% is, we've got chaos, 3% is a catastrophe. So, but again, the Fed they're not trying to scare the public, but you know damn well they're scared, going, what the hell do we do? All right. I just wanted to give you that because, you know, call your guy, call your girl, whoever it is that handles, your financial professional, and start asking what they think about what's going on. And when they're like, oh, you need to buy Bitcoin, or, now would be a great time to buy more shares of Apple, time to find a new broker. Okay. But guys, this is what's going on right now. And I just wanted to give you a heads up. All right. See y'all later. Have a good afternoon. Pinball out.